Central banks all over the world are piling up gold in their accounts. Why? Today, we're going to look at several things about gold that are culminating into what we're experiencing right now. For years, gold has been this miracle storehold of wealth, which was dependable. And even when the governments all over the world want to establish a currency, they start by basing it on gold first. Although, in the end, as we shall see, even the most trustworthy of governments end up breaking that promise of pegging their currency to gold. Also, we are going to explore a few relationships between gold and macroeconomic variables that most people often mistake or get wrong. Most notably, the relationships between interest rates as well as other variables like currency. All those get mixed up a lot when talking about gold. And then we're going to look at, should you even have gold in your portfolio? Because as we shall see that gold doesn't always go up, and there are things that cause it to go up, others that cause it to go down, and others that don't, that make it not change at all. The last century began with gold pegged to the dollar, or the dollar pegged to the gold. And it was about $1 for an ounce of gold for $20. That kept up until we were about in 1930, when there was a big stock bubble and a crash, and also the first Great Depression that happened. And we had people wanting in like dire need of cash. But there was this law that had been put in place that the central bank shouldn't have more than, or there shouldn't be less than 40% of gold that is backed up by the currency. What do we mean by that? If we have $100, then we shouldn't we want to have at least gold that is worth more than $40 or more. So that constrained the amount of credit in the economy, and these are Great Depression. So everyone is like, there's no money in the economy, and since there's also like there's a constraint to the amount of credit, there was no liquidity in the economy. And I think the central bank, the Fed, the central bank of the US, learned from this. And during like financial crises, like for example 2008, you see that the central bank usually like prints a lot of money, gives people money, which we can call increasing liquidity. But basically, it's just like printing a lot of money and pushing a lot of money into the economy so as to encourage economic activity and so that the economy doesn't collapse. So that did not happen in the 1930s, and that is one of the things that made the economy severe at that time, and one of the things that encouraged like the Fed later to be doing a lot of easing, a lot of injection of money into the economy. So what happened is that the US president then broke that, sort of the rule was done away with, okay, and they devalued the currency, they devalued the currency with respect to gold. So instead of having 1 ounce of gold for $20, they had 1 ounce of gold for $35, and that's increased the amount of money that could be injected into the economy. So since about 1933, when the new devalued peg came in, there was a constant, the gold was just like pegged, the dollar was pegged to the gold all that time, and there was no major interesting things here until what we had were other countries for example, France. This is the most like well-known story. France had a lot of U.S. bonds that it had lent the US government money and received bonds, US bonds, in place of the money. And so what it did was go to the US government. So remember, or the US Fed, and remember that our dollar is pegged to the gold. So 1 ounce of gold gives you about that $5. So what the French government did was go to the United States. They even came with big army ships. And they went to United States and they said that we want our money back. We are selling our bonds. You'll have to give us dollars. Instead of giving us dollars, what we want now. I might be mistaken. I think they went with actual dollars, not bonds. But I think the effect would be the same. So they said that we want these millions and millions of dollars given to you, and then you, the United States, are going to give us gold. So that was like one of the things that sort of revealed that the US did not have enough gold to keep their promise that $5 could be exchanged for an ounce of gold. So other countries started like piling in, and others demanding that the US give them gold in exchange for dollars. So what happened is that the then president around 1971, the then president, US President Nixon, so that this was not going to be sustainable. If everyone came asking for gold, then there wasn't going to be like any more gold for the US. And remember that the goal was like that US having gold was the thing keeping the whole world economy in place. So what they saw is that they need to stop the Fed from bleeding any more gold, and the gold peg was suspended in 1971. So what happened, and what will inevitably happen, was that the dollar was eventually devalued, and we had the price of gold rising. So it just like shot up from 1970 up to somewhere the mid or late 70s. And that was a response to breaking the link between gold and the dollar. And one of the things that marked the late 70s was the oil crash, and then there was like a very, very bad inflation, very terrible inflation. I think the worst inflation ever experienced by the United States, and I think the world. So what happened then is that a lot of people wanted to have a stable place where they could store their wealth, because if the inflation is like running at 20%, it's a very large inflation, and that eats up into your wealth. So what people did was demand more gold, and since right now gold was very legal to trade, unlike before, during the gold pegs, gold was illegal. It was illegal for a person to hold gold. You, as a person, could not trade gold. But after the peg was broken, it became legal for individuals to buy gold. So you could use gold as a storehold of wealth. And what happened is that during this inflation, where wealth was being threatened, people made purchases of gold, which drove its prices up and up and up. And by the 80s, by 1980, the interest rates, the US government had hiked interest rates. Interest rates basically and fundamentally are usually designed to deal with inflation. So when inflation rises, the banks usually raise interest rates, and that has the effect of bringing inflation down. But it also has the effect of causing people to demand bonds, US bonds, or to transfer their wealth into bonds, into because bonds are paying much better. So after there's a lot of movement from gold, which doesn't pay a lot of interest, into bonds, because bonds are paying better in terms of returns. It's this simple. You have an ounce of gold. In a year's time, you'll still have an ounce of gold. If you decide you're going to hold it. In a year's time, you'll just have an ounce of gold. But let's say that you, instead of the gold, you go buy a US Treasury that's paying, I don't know, 15%. Interest rates at this point were really, really high, and people preferred to buy bonds instead of holding their money in gold, which doesn't pay interest. So that pushes the price of gold down. And from 1980s up to 2000s, the interest rates were fairly good, and the economy was basically growing, and there wasn't much drama until the turn of the century came, which is when like the internet companies were blowing up and people wanted to get rich off of the internet. And what happened is that a lot of money went into stocks and was also lost in stocks after there was a very terrible crash. So the turn of the century sees this internet bubble, the dot-com bubble, and lots of people lose their money in the crash. So if you're liking the video up to now, you can press that like button. So what happened after the crash? Lots of people lost confidence in the workings of the economy and in the ability of the government to protect them. So what happened is that during the first decade of the century, that is 2000 to 2010, remember there was the dot-com thing, there was the dot-com bubble, there was the terrorist attacks in 2001, and then there was the housing bubble and the global financial crisis. All those things sort of made people lose confidence in the government's financial ability. So a lot of money went out seeking gold, which appeared to be a stable storehold of wealth. And that's what happened during this 2020, 2000 and up to about 2011 period, which was further worsened by the global financial crisis. So we see that after, remember that the central bank had sort of learned that after a crisis, it's best to inject a lot of money to the economy and also like lower interest rates so that people could get credit easily, which has the effect of strengthening the economy. So what ended up happening is that after the crisis was over and the economy was in a good place, the central bank started raising rates. And raising rates, if the economy is healthy, will mean that people will prefer an asset that gives return, e.g., bonds, than an asset which doesn't give returns during that time, that is gold. So what happened is that people got their money from gold and injected it into treasuries, US bonds. So that created a period in which the price of gold went down or stagnated during the last decade. So in the last decade, in 2019, 2020, that's when COVID hit, and which had the effect of pushing prices of gold even higher due to the high levels of uncertainty. So recently, what has been happening is that there is this Russia crisis. Russia had about 300 billion or 300 billions worth of US treasuries, and after it went to war with Ukraine, the US government sort of defaulted or sanctioned Russia, which is basically saying, yeah, we're not going to pay you back the money that you gave us. They're effectively the same. So other countries saw that, okay, this is something that the United States government, which is considered to have the safest asset on earth, which are the US bonds, the United States government can refuse to pay back someone just okay. War might not be a good thing, but other countries saw that the United States government might not have been as reliable borrower as they thought. So up to now, that doubt of the ability of the central bank to pay has sort of affected the price of gold, because central banks all over the world are rushing in. They're buying gold everywhere and they're piling up gold so that they can diversify their reserves, so that in case the US decided to do to them what they did to Russia, they'll be in a good position. I think countries like maybe China has been leading uh, central banks in buying gold. So, and they're not like really best of buddies with the United States. So that's what is causing the price of gold to push up. If the tensions remain, I think it would be very wise to place your money in gold, and especially if you're not from the US. Also, I think it's basically like a good idea to diversify your portfolio. That is, if you to have stocks and to have bonds, to have other assets, so that in case of a downturn, you're not like wiped out completely. So that's the history of gold, and I think it's an important aspect to understand, because it's frequently misunderstood, especially with how it relates to interest rates. It's not all the time that high interest rates will be leading to. It's not all the time that high interest rates will lead to a decline in the price of gold. For example, right now, interest rates are moderately high. They're not too high, but they're high enough compared to gold. Gold gives you 0. Right now, US treasuries give you about 3.5. So that's a significant difference. And we've not seen a decrease in the price of gold due to the geopolitical tensions. So there's a lot of factors that end up affecting the price of gold, and it's not just one single thing.